everybody thought that the mortgage refinance boom was going to come to a halt and that the housing market was going to slow down because mortgage rates started to go up, so it would be less attractive to refinance your mortgage and it'd be more expensive for you to go out and buy a home. But the Federal Reserve said, take the housing market to the moon because we're seeing mortgage rates come back down again. What's up everybody, I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. The housing market has been a very hot topic because as soon as the pandemic hit, we entered a recession and the Federal Reserve Bank came in and they slashed mortgage rates to near zero. And that's when people started to refinance on their mortgages because interest rates fell so low. And that's when people were like, I can go out and buy a home right now and pay very little on my mortgage payments. So you had this massive boom in people who wanted to buy a home because people wanted to take advantage of these cheap interest rates. Let's take a look at a timeline of 30-year mortgage rates between 2020 and 2021. Back around January 2020, a 30-year mortgage would cost you something like 3.7% a year in interest. Now, the reason it was already kind of low in the early part of 2020 was because in 2019, the government and the Federal Reserve Bank were already concerned about a potentially slowing economy, so they started preemptively slashing interest rates to boost the economy, which is why in early 2020, we already had a pretty low interest rate. But then around March, that was when the pandemic hit, and that's when interest rates were cut again by the Federal Reserve Bank. So in March, interest rates came down to right around 3.3%. In July of 2020, that's when interest rates on a 30-year mortgage came down to right around 3%. And by the end of 2020, mortgage rates had come down to right around 2.7% for a 30-year fixed. Now, if we go into 2021, so we go into January 2021, we started 2021 with interest rates just below 2.7% for a 30-year fixed, which is absolutely insane. But then interest rates started to go up. So by March and April, so let's write April, and this is 2021, mortgage rates came up to right around 3.3%. This is early part of April. And so everyone was getting really worried because mortgage rates started to go up relatively quickly. I mean, if you look at from March to December, it took quite a while for mortgage rates to go from 3.3% to 2.7%. But in 2021, it was only between January and early April for mortgage rates to go from below 2.7% all the way up to 3.3% and sometimes a little bit even higher than that. But now towards the end of April, mortgage rates have dipped again to right around 3%, sometimes even a little bit lower than 3% for a fixed rate 30-year mortgage. And so interest rates have been coming down again. Dropping mortgage rates bring up more concerns about inflation and the housing market and kind of the general state of the economy, which is why in this video, I'm going to be talking about what's going on and what you need to know. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. And also, if you are interested in seeing bite-sized pieces of financial education, you can check out our brand new Minority Mindset Shorts channel where we're posting content every single day and all these videos are less than 1 minute long. So if you want to see our Minority Mindset Shorts channel, I'll link that for you in the description below. I want to start by talking about why mortgage rates started dropping randomly in the middle of April. So interest rates are set by the Federal Reserve Bank. The Federal Reserve Bank is known as the central banking system in the United States, but what you got to understand about the Federal Reserve Bank is they are not really a bank. And they're not really a reserve, and they're not actually federal. The Federal Reserve Bank is an entity which helps regulate and monitor the monetary supply in the United States, and one way that they do that is by regulating interest rates. When the Federal Reserve Bank, or the Fed, feels that we are in a slowing economy, they will cut interest rates to make borrowing money cheaper to help stimulate the economy, because when people have more money, they have more money to spend, which will help get the economy going. And so the Federal Reserve Bank cut interest rates when this pandemic first hit, and they keep saying time and time again that they're going to continue keeping interest rates low until the economy recovers. And as of now, at the time we're recording this video, the Federal Reserve Bank keeps saying that they're going to keep interest rates near zero. Now, the interest rate that the Fed sets is called the federal funds rate. This federal funds rate is not the interest rate that you borrow money at when you want to buy a home. This federal funds rate is the interest rate that banks borrow money from each other at when they lend each other money. And so the thing you got to understand about this federal funds rate is that although it's not directly what mortgage rate you're going to be paying, the lower this fee is, the lower your bank's fees are, and the lower they're going to charge you interest for your mortgage. That being said, if the Federal Reserve Bank keeps saying that they're not going to touch interest rates, why are mortgage rates dropping again? Well, I'm not a mortgage expert. I work worked in the real estate space. I'm a licensed attorney. I've worked as a real estate agent. I'm a real estate investor. But on the mortgage side of things, I don't know everything. However, I do have this article on the mortgage reports. This article says that in general, if you have stronger than expected economic readings, you would expect that interest rates would go up. And if you have worse than expected economic reports, then interest rates should go down. Well, in April and March, what they saw was that the economy was booming. So they said they would have expected the interest rates would have gone up. However, interest rates fell, even though the retail sales got their biggest boom in a year, and even though the inflation rose more than expected. Even though we kept seeing more inflation and more sales, interest rates still went up. Why? Well, according to this article, the simple answer is because we are not in a normal market. We are still in a pandemic, and this pandemic is driving the market and the mortgage market that we're seeing right now, because right now we're seeing cases of this virus shoot up, and we had to deal with issues like hearing that the Johnson & Johnson vaccine was going to be put on hold. So it sounds like mortgage rates have been coming down kind of preemptively to keep the economy moving and to keep the housing market booming, even though cases of this virus keep going up, even though we all thought that we were towards the end of this pandemic. However, the article does say that they expect mortgage rates to continue to go up pretty significantly by the end of this year. The next natural question you might have is, how do these lower interest rates now affect the housing market? Well, cheaper debt means it's cheaper for you to go out and borrow more money to buy a home. I'll show you what I mean. Let's assume that you, I'm gonna draw you right here, want to buy this beautiful, gotta draw you a nice mustache, this beautiful $400,000 home. Wait, I cannot neglect our female followers, so let me draw a lady right here. Gotta draw you, as we say in my native language Punjabi, a gut, which is a braid. So you want to buy this home and you're taking out a $400,000 mortgage. Now, if you got this mortgage at a 3.3% interest rate, that means this mortgage is going to cost you just over $1,750 a month, just over that. But if you can get this exact same $400,000 at 2.7%, which is what we saw kind of in the early part of 2021, then you would get this mortgage not at $1,750, but just over $1,600 a month. So we're talking about a difference of about $150 a month. So if your budget is $1,750 a month and mortgage rates come down to 2.7%, now you got some more room to play on the purchase price, because now if your mortgage is only costing you $1,600 a month and you can pay up to $1,750, now what you can do, if you got a bid to buy this home, because this is a seller's market and everybody's competing against each other to buy a home, you can say, you know what, I'm not just going to take out a $400,000 mortgage, I'm going to up the price. Now I can afford a $425,000 mortgage, because now if you take a $425,000 mortgage, that's going to cost you right around the same $1,750 a month. So when mortgage rates fall, people can afford more money to borrow. Now, I'm not saying this is the right thing to do. I'm just saying this is what happens. People can afford to borrow more money, which pushes home prices up even more. So if you're in the process of buying a home, lower mortgage rates are good, because now it's cheaper for you to borrow money. And it's also good if you were thinking about refinancing your mortgage, because now mortgage rates are lower, which means you can borrow money at a lower interest rate, meaning you could keep more money in your pocket. A lot of people were worried that they missed the refinance boom because mortgage rates started to go up, and so people were kind of hesitant to refinance. But now mortgage rates have come down again, so the people that missed that opportunity to refinance their mortgage have another golden opportunity to refinance on their mortgages and save potentially a ton of money just by refinancing their mortgage into a new, cheaper loan. But these lower mortgage rates probably are not going to last very long. So if you are interested in refinancing, it's better to do it sooner rather than later. That way you don't miss out on these new lower rates. If you are one of those people that's looking to get a mortgage or looking to refinance on your mortgage, make sure you are shopping around, because some lenders are going to charge you a whole lot less in interest and fees on the exact same loan than other lenders. So do some shopping around, because they can save you a ton of money on the exact same mortgage. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage and refinance rates at no charge to you. They have multiple lenders competing on their marketplace, so you can compare great rates and pick the option that's best for you. The process is really simple. All you have to do is go onto Credible's website and then enter in a few pieces of information, which just takes a few minutes, and then Credible will present you with actual pre-qualified rates. That way you can compare. Credible's pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do it with Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do it with Credible in the description below. This brings me to the topic of the future of our economy and the concerns that a lot of people have about our economy and the housing market. Anytime you see any asset class, whether it's real estate or cryptocurrency or the stock market start to boom at an insane rate, people start to get nervous because naturally everyone knows that nothing can go straight up forever. And so we've seen housing prices go almost straight up since this pandemic started, and so people are a little bit nervous. Now, the good news here is that people are buying homes with equity because we're not seeing a lot of the 0% down or the ninja loans that we saw before the 2008 crash. And the second piece of good news here is people are buying homes mainly with fixed rate mortgages, not with the variable interest rate and teaser rate mortgages that we saw happen before the 2008 crash. The reason why this is so important is because when the 2008 real estate crash happened, it was super simple for anyone to qualify to buy a home. You didn't have to have a job, you didn't need assets, you didn't even need money as a down payment. Anybody can go and buy a home. And when people were buying these homes, they were buying homes with these variable interest rates. What that meant was when you got a mortgage, you would start off with this very low teaser rates. So your monthly payments were super low, and everybody thought, wow, it's so easy for me to afford $1 million home. And then 5 years later, mortgage rates started to go up because then your mortgage rate would readjust every single year. And because interest rates are going up, everyone's monthly payments started to shoot up. And then people all of a sudden had no equity in their homes and they couldn't afford their monthly payments. So people just started to walk away. We are not seeing that same level of variable interest rate mortgages or the same level of no money down mortgages. However, what you do want to pay attention to is as interest rates go up, because there's a very good chance that mortgage rates are going to go up from here. I mean, it's pretty much guaranteed that mortgage rates are going to go up over the next couple of years. But as mortgage rates go up, if people are still not buying homes, then what you want to pay attention to is what happens. What incentives will banks create to keep people buying homes? Because this has been a booming housing market. If you see banks come out and then they start advertising these variable interest rate mortgages again to people who don't understand them, then that's something to be worried about. If you see banks come out and they start offering these no money down mortgages to people who shouldn't be buying a home, well, then that's also something that you really want to be worried about. The housing market is determined by supply and demand. Right now, we have a very low supply of homes available for sale, and one of the reasons for that is because people are not selling their homes, and another reason for that is because it is super expensive to build a home right now because we have a labor shortage and a material shortage. Like the price of lumber has skyrocketed between 2020 and 2021, so it has become so expensive and so difficult to build a home, which is why the inventory of homes has been low. At the same time, we've seen this massive demand for people to buy a home because mortgage rates have been slashed to historical lows, and so everybody's trying to take advantage of these super low mortgages. And so people are buying homes. Everyone wants to buy a home because mortgages and money is so cheap to borrow, and there's a very low amount of homes available for sale. And so now all the buyers are having to fight against each other to buy a home, which is creating these bidding wars, causing home prices to shoot up like this. Now, our economy is growing. One of the reasons for that is because we were hit so hard by this pandemic. So we're growing very fast because we were hit so hard. I mean, we're not back to where we were before this pandemic. We're just growing quickly because we're in the recovery phase. The question is, what's going to happen next? Right now, our economy is still surviving because of all this free money by the government, thanks to stimulus checks and unemployment checks and bailouts and grants and just free money that the government is throwing around. But once this money stops being printed, because eventually, I don't know when, but eventually this free money has to stop being printed. At least I hope so. But you have to think that this money will stop being printed. And when that happens, that's going to be the real test of our economy. So as our economy starts to grow, as we start to see more jobs, these are things that can continue to kind of fuel the housing market on one end, because as more people get a job, more people are going to have an income. As more people have an income, more people will be able to qualify for a mortgage, which means more people will want to buy a home. Now, obviously, this demand to buy a home has to be matched with supply. Right now, we have a very low supply of homes, which has been pushing home prices up. But as more homes are built and as more people sell their homes, eventually you're going to hit a tipping point where supply starts to go up and you're going to have a bigger supply of homes than demand. I don't know when this is going to happen, but eventually this will happen because every asset class is cyclical, including real estate. So eventually you are going to hit a tipping point where you're going to have more supply than demand. And when that happens, you will see home prices start to correct, because you cannot see any asset price, real estate, stocks, gold, it really doesn't matter what you're talking about. No asset price can go straight up like this. Now, just because you see a correction doesn't mean that you're going to see an all-out crash. I mean, corrections happen. That's part of the economy, and that's a part of all assets. But the thing that's kind of most directly tied to lower mortgage rates is inflation, because as interest rates go down, people borrow more money. As people borrow more money has to be created, and this money is now injected into our economy through the form of loans. And as more money is injected into our economy, there's more dollars floating around, which causes more inflation, which causes the price of everything to go up. I already made a video where I explained how our economic system works. So if you want to learn more about that, I will link that video for you in the description below. But essentially what you have to understand is that there's two types of money in our economic system. We have actual money. This is the money that you have in your bank account. And then we have credit, debt. And so in the economic system, nobody can tell the difference between money and debt, because when you go to a restaurant and you spend $100, the restaurant owner doesn't care if this $100 is coming from your bank account or if this $100 is coming from your credit card, because you don't have $100 in your bank account. In the economic system, this money and credit is spent the exact same way. And so when we talk about inflation, inflation is when the value of our dollars are diluted because more dollars enter our economic system, and this causes the price of things to go up. As more and more people are borrowing money because interest rates are lower, we have more dollars entering our economic system through the form of credit and debt, which causes more inflation, which causes the price of things to go up. Now, typically in a normal environment, that's not such a big deal, because it's normal that as interest rates go down, people will borrow more money, which will create more money, which will be injected into our economy, and people will spend this money. But the reason why this is so kind of strange now is because not only do we have all this new money that's being printed through the form of debt because people are borrowing more money, but we have also seen trillions of dollars printed by the Federal Reserve Bank to fund all of these stimulus programs. I mean, between 2020 and 2021, we've seen more than $4 trillion printed by the government to fund all these stimulus packages. So we have trillions and trillions and trillions of dollars being printed by the government, and we also have more dollars being injected into our economy because of all this cheap debt. And so naturally, people are worried about inflation, because we have more dollars entering our system. As we have more dollars in our system, each dollar that is out there doesn't have as much buying power. I mean, that's one of the reasons why people are kind of treating cash like funny money. I mean, there's all this talk about people buying so many homes with cash because there's so much cash out there right now. There's so much money out there where now it's kind of like to the point where our cash is losing value so fast, where it's almost becoming worthless. I gotta catch myself when I say that, because yes, right now we are seeing inflation. We are seeing the value of our dollars drop, but we're also not really on the verge of hyperinflation right now, because luckily the United States is kind of the world superpower. Our dollar is the world's currency. We have the strongest military in the world. So still our dollar is very strong, even though we've been printing all this money, but we're still seeing more inflation, which means a lot of people are losing value by saving their money, and a lot of people's earnings are not going to have the same buying power as it used to. It's kind of a strange concept, because no one kind of sees the link between mortgage rates and inflation, but it's starting to be seen now, just because already, yeah, we have a lot of kind of money entering the system through debt, but also because of all the money printing that we've seen happen between 2020 and 2021. So this is something you want to be aware of, and this is something you want to kind of understand. That way you're making smart decisions with your money, which is why if you haven't subscribed to our YouTube channel yet, make sure you do that. If you enjoyed this video, here's a video on things that you should not do when you get paid, and while you're at it, download our free money management PDF, and as always, keep hustling. This money that you're paying 15, 16, 17% interest on is so expensive, and it is destroying your wealth. It is making your credit card company wealthy. It is making your hard money lender wealthy.